Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scoville.
All right, welcome back to the Wealth Well Done podcast. I'm your host, Eric Scoville. This is episode number 10, and today we are blessed to have Tom Costello joining us. Reminder here within the podcast, what we're doing is we're going after those tactical, practical, and spiritual advice to help you do your wealth well done. Last week, we had Cal Rickner on as we talked about how to do a successful succession planning. And so, full disclaimer, as always with this, the information that we are sharing today is meant to be informative and is not meant to be financial advice to you. So if this doesn't fit this may or may not actually fit your actual situation. So we ask you to take all this advice in, as well as the same way you would any other advice that you'd receive on the internet. Bounce this off of your own, maybe better than what you'd receive on the internet, but bounce this off your own financial team to apply this to your situation before you go make any decisions on your own. And I've mentioned this before here, but our production team has told me don't spend much time talking about the background of the guest and jump in right into the meat of what we have to talk about. The guest today has a storied enough career, a good enough background that I feel like it was worth Tom sharing just a little bit of his background to establish some credibility as we get into the topics today. So, Tom Costello, will you introduce yourself to the audience today,
I'm more
please?
than happy to. I started out as a quant at JP Morgan in the 1990s. I worked on the institutional financial side and the banking side for half a dozen years, and then I made a switch to what we call the buy side, which is the hedge fund world. I was a quant at places like Moore Capital, Caxton Associates, and Tudor Investments. Most people don't know the hedge fund world very well, but these were three of the top 10 hedge funds in the world for 30 years. The people that run these firms are industry legends. The name Paul Tudor Jones, you might have heard. Louis Bacon, you might have heard. These are a couple of the people that I work directly for. I managed money on the hedge fund side for quite a while. I was head of equity trading at about $1 billion quant fund after those institutions. And I never had a down year in traditional finance. So I'd had months where I traded down, but during that period, I'd never had an entire down year. And that includes trading through 2008, 2009 financial crisis, where even then we managed to eke out a profit, albeit a small one. So it's kind of what I've been doing. I've been involved in the hedge fund industry for a very, very, very long time. I know a great deal about it.
Okay. All right. And we're going to get into that whole piece around your trading record, because I think that speaks volumes. And just so the audience knows as well, Tom is a partner of ours in the hedge fund that we have. So we're going to spend more time next episode talking about that. But I just want to make sure you know that again, Tom and I do business together as well. Tom, will you give a background? And I think as this episode goes on, we might get more and more sophisticated with the conversation. But just to start, for someone who's who's more of a retail investor or hasn't been exposed to institutional finance, will you give a background on a high level, what is institutional finance?
Sure. Well, in institutional finance, there's different pressures on the people who participate. Institutional finance is people who manage money professionally for large institutions. So all of the pension fund money in the world is managed by people in the institutional financial business. Most of that flows through either hedge funds or investment banks, or both, or a combination thereof. All of the public pensions, most of the private pensions, all of the college endowments. There are things called family funds, which are fund managers that represent the interests of various wealthy families. All of that money is pooled up and is essentially managed by the same, call it 2,000, maybe 2,500 people globally that make up the top tier investment banks down to about the middle level and the hedge fund world. So that's
Okay.
For retail people, there's different pressures on people like that. One of the biggest ones in institutional finance is you can't lose money. So if someone's managing their own money, you can have a down month or a down year or whatever. You can lose 50% of your money and just extend your investment horizon. If you're willing to wait 20 years, you buy the S&P, it goes down 30%. You don't really care because you've got, 19 years or 19 and a half years for it to come back, and it almost certainly will. In institutional finance, you don't really have that option. There's extreme pressure to deliver all the time, because if you don't turn a profit, they'll get rid of you and get somebody else in there who will. So that changes a lot of the decision making that people on the institutional side take on.
Okay. All right. So let's talk about the way that wealth is managed. Because if you look at this, you say, the majority of the wealth in the world is going to be professionally managed.
More than 90%.
So
way more than 90%.
So if we talked about, let's maybe first talk pension funds, and after that we'll go after on the individual, family office, high net worth style. So how are pension funds managed?
Well, let's start with the largest of the funds, right? Because it's a little easier to understand where the pressures are applied. So the Sovereign Wealth Fund of Finland, I believe, is the second largest pool of money in the world. So they can invest in, and essentially do invest in, absolutely everything. They have money dedicated to the U.S. stock market, the U.S. bond market, the U.S. derivatives market, the European markets, the Middle Eastern markets, the emerging markets, and they have money committed basically everywhere. And their goal is to always have enough cash to pay those pensioners their dividend, right? So they can take no chances. Mm-hmm. They are highly, highly regulated as to what they can and cannot do. And because they're invested in everything, what they're always seeking is what's called discrete alpha. It's they're looking for a return which is positive, which is uncorrelated from all the other things they're invested in, because that gives them a little bit of a hedge. If the markets go down, sometimes markets all go down together, right? So, they have money in the U.S. market, they have money in the European market, and the Canadian stock market, and all of these markets start to fall. They've got to go somewhere, so they've got to have an investment which will gain when those lose. And that's their goal. They try and put together a diversified portfolio that includes almost every market in the world. Most individual people don't have anywhere near the resources it would take to do that kind of thing, right? But if they were to say...
And we're not just talking about the money to invest, we're talking about the money to invest the way they invest.
That's right,
The difference there.
Most people, if they wanted to buy one share of Canadian stock and one share of U.S. stock and one share, it just isn't enough to make the big difference, right? They tend to focus on an individual market, and retail people will tend to focus on an individual market and trade that, which I would also say is probably not a great idea for them, right? Because if you're trading, if you're actually engaged in actively buying and selling things, and trying to time the market and get it right when it's going up and sell it before it goes down, that sort of thing, what you're really doing is you're competing in what is, for all intents and purposes, a zero-sum game, where the other people who are doing it with you do nothing else from 7 in the morning until 10 at night, 6 days a week, all year, right? This is their entire job.
Right.
And for you, it's probably a part-time thing. Maybe you have your own business or some other thing. So to engage in trading activity for a retail person is probably a losing bet. There has been circumstances where people have made money at it, but not typically for very long. And it just doesn't work out well. It's usually a much better plan for a retail investor to be a buy and hold sort of investor. Find something you like, trade it more like Warren Buffett. Buy it in 2023, sell it in 2028, and you'll make plenty of money on it.
Right. I think we're going to come back to a little bit of the demand on hedge funds and hedge fund managers here in a second. If you were to So for someone who's had limited exposure to hedge funds, they talk about hedge funds in a sense that. So I'm gonna reference your book. So Tom's book here, The Front Office. Let's see if I can get that on the video right. And so on the back of your book here, you make reference to basically what the Wolf of Wall Street and the picture that presented. A lot of people, that's their exposure to hedge funds. They think that all of them are just greedy, nasty, slimy people. But you're basically saying the top tier of institutional trading has as little in common with a bunch of nearly illiterate stockbrokers scamming their retail clients as driving a bus on the New Jersey Turnpike does with trying to win the Monaco Grand Prix.
That's very true.
So if you went into the, understand, so many people have a very limited exposure to hedge funds, and some of the people who are listening today aren't going to know much about that. Can you give us a background as to what is a hedge fund actually, and what's the purpose of it? Why are the ultra high net worth individuals, pension funds, those people, why are they using hedge funds?
Sure. So the role that hedge funds play in the industry is that they are a hedge. What they do is they deliver a return stream, a positive return stream. So you're making money with a hedge fund, but in a perfect world, you would be making money in a way that is uncorrelated to other markets. So stock market goes up, stock market goes down, it makes money. Crypto market goes up or down, makes money. Right? What you want is something that is going to be completely independent from all of those other assets that you're buying and selling. That's what the pension funds are looking for. They literally treat hedge funds as a hedge. The sector is actually called alternative assets in the institutional world. And pension funds are strictly limited, depending on the jurisdiction, to 5 or 10% maximum in alternative funds. So a hedge fund at best, at most, would be no more than 10% of, and that's even if it's a multi-billion dollar, even if it's BlackRock, say.
Yeah.
As far as the culture, though, yeah, and this is probably where you wanted me to go in the first place. I'll get there. It is a dull, mostly dry business. Very, very hardworking people. I always tell people I've worked with some of the smartest human beings on the face of the earth. I've been surrounded by them for most of my career. There's been many, many times where I didn't know anybody who wasn't a genius. These are the best educated, hardest working, most highly motivated people in the whole world, gathered up by Wall Street, dumped down into the industry to compete head on head with each other, where for those who win, it's vast wealth. So it's an extreme pressure cooker sort of environment, but it has nothing whatsoever to do with the Wolf of Wall Street. Nobody drives a Ferrari. Nobody. In fact, there's actually been a study that says if you hire a hedge fund manager with a boring car, he's more likely to make you money. That's how seriously these industry takes it. There's an NYU study. You can find it online.
Okay.
So, yeah, nobody drives a Ferrari. Nobody has a supermodel girlfriend. Even the guys who are multi-billionaires and single do not run around like Elon Musk marrying, singers. It's a very steady, low-key, very conservative industry where your reputation is 9/10 of everything that you accomplish. If your reputation, if you get a reputation as being unstable, unreliable, or doing things that are contrary to the interests of your investors, you're not going to have a career anymore. And people will go to fanatical levels to manage their credibility and manage their reputation at the top tier of the space. It really is absolutely nothing like the Wolf of Wall Street.
Okay. We're going to get into, so moving on here, we're going to get into quantitative funds. We're going to get into the banking situation, into interest rates in the Fed. But I want to this is a good time to touch on the spiritual side of things. And so I want to go deep and personal with you here for a minute. So next week, we're going to talk more about the hedge fund that we have. But so Tom, you had been in the hedge fund industry for, I think, 32 years before we joined together.
Banking and hedge funds for 33 years. Yeah.
Okay. Yeah. So here you have this, in a sense, a bit of an illustrious storybook type career here with not many people can say I was able to trade for that many years and never have a down year. so you come on with us and we get started into the cryptocurrency industry, and we'll, like I said, we're going to spend more time talking about that now, because we don't consider ourselves a crypto fund. We consider ourselves a hedge fund that uses the cryptocurrency industry to try to, I don't want to say exploit's the wrong word here, but try to find the abilities to generate a profit inside that industry. We'll leave the details for next week. But last year we had a down year. The cryptocurrency industry got decimated.
It did indeed, in lots of ways that no one could have possibly predicted.
Correct. So in a lot of senses, we had, in November we got the world's best performing hedge fund from the Barclay Index. We've got on the crypto side, we've had a lot of success along the way avoiding the big collapses, but still, that's been a time where, as pressure is turned up on the hedge fund manager and the struggles that last year created, how has that been on you personally and spiritually? So to an audience member listening to this, you might not be a hedge fund manager. You might not have the pressure of managing institutional finance, but you certainly have pressures. You have things that you're dealing with as well, and they don't always go the way we hoped. I had gotten into this career or into this industry this was an answered prayer, trying to do something I feel like God is leading me into, and it has not gone storybook.
It certainly hasn't been without its obstacles.
So can you just give a piece of light to how this has been on the spiritual journey for you, dealing with the struggles that we have?
Not talking about the specific events. No one wins every time. I rely a great deal on what I view as absolute universal truth, right? The same way that you try to let your attitudes be defined by your personal relationship with Jesus, I have a personal relationship as well. And part of that relationship involves me having facts that I can rely on, ways that the universe has been defined by God that aren't going to change. And part of that, I am essentially a glorified mathematician. That's what I've been for the last 30 years. And a great deal of that is about identifying fundamental truths, things which are constant or permanent, and are in essence a part of God, right? So,
yeah,
we've had a bump or two. We've had more drawdown than we would have liked, less than we could have. We managed to escape the jaws by a razor several times, and these were things that many others in the industry done. We go to various industry events every year, and we went to one 2 years in a row now, and there were, the first time we went, there were 75 hedge fund managers. And the second time we went, there were 15, of which we were one. And that's because so many people were literally wiped out. Businesses were wiped out entirely. So we managed to stay ahead of that. And I get encouragement from the fact that we're still in it. We're still fighting. And I know that if you do it the right way, I believe that if you do it the right way, eventually it will come to you. You just have to do it the right way. That's harder than it sounds and harder than you think it's going to be. But I have an absolute faith in it. I believe that if we strive to do the right thing, and I don't believe we've ever had anything but the best intentions, then it will come to us eventually. And, and not to get into the specifics, but we've had substantial successes, and we're having one of them at the moment. That many things that we've worked on for a very, very long time, against overwhelming obstacles, we've managed to see to fruition. So the next few months, we expect things to be very, very encouraging. And
I think one of the
key is look forward, right? It's the first rule of Italian driving. What's behind is not important.
I think as I've processed this and I've spent a lot of time and deep reflection through this, that the universal truth that's been there for me is where my identity is. And if my identity is in the returns that I'm able to, the return sheet that I give an investor at the end of the month, if my identity is there, then it's a ship tossed around by the waves, and it's you're only as good as the last month, and that's where it stands. And it for me, it had to turn into my identities in Christ, and I think that this journey has really helped me draw deeper to that truth, that my identity is in Christ, which means if the hedge fund blew up completely, or if the hedge fund has massive success, doesn't matter. It doesn't change.
Change who you are.
Truth.
Doesn't change your position in the universe.
No.
I wrote a book about trading, and so I'm pretty confident in saying it's the only trading book that's ever been written where a Catholic saint was prominently featured. So I'm pretty confident that it's the one and only time that somebody actually mentioned a Catholic theologian, Thomas Aquinas.
Yeah. Yeah, no, you're probably right there. All right. Thanks for letting me go spiritual there for a second. Let's go back into what briefly, because I want to get into topics that are very relevant today. But what is a quant? And so I'm going to go, what's a quant? And then what is the difference between what's a quantitative hedge fund? What are the characteristics that define a quantitative hedge fund?
So a quant, that word quant has been a job description since about the time that I arrived at JP Morgan, maybe the late 80s, they started using that term. It describes people who have a background in physics and economics, heavy math guys, who came onto Wall Street and arrived right about the same time that the personal computer did. So it used to be, if any of your listeners go out and buy a book on how to trade on Wall Street, they're going to buy a book that really describes pre-computer era technology, things like support and resistance and maybe Elliott waves or DMA channels and relative strength indexes. And all of that stuff was useful in a limited way, but it was all pre-computers. Once computers arrived, institutional Wall Street, the big banks and the large hedge funds, they changed everything about what they do. What they started doing was using strict mathematical discipline. If you've ever seen the movie Moneyball, what people used to do was like the agents, right? They'd go out and say, well, he's got an ugly girlfriend, but he's got a really strong arm. And we think he's got a lot of, moxie, whatever moxie is, right? And that was the old way. That's the way that most retail people learn how to deal with the capital markets. But what a quant does is applies absolute strict mathematical discipline. It's the law of probability and statistics. So we have, in the quant world, we have something that's sort of a unified field theory of finance, and that goes literally like this. All of finance is a probability of discounted cash flows. That phrase describes everything in finance. There is no circumstance in finance where that phrase can't describe it. So what we do is we try to calculate the odds of this asset going up, the odds of it going down, the odds of it going up fast or slow, or going down fast or slow, the odds of certain relationships changing in the markets where this one is ahead of that one, but now that one is ahead of this one. And what we do is we calculate the probabilities around all of those, and then we bet the way the odds say to bet. Some risks cost very little, but have a potential to deliver a great deal. Others cost a great deal and have a potential to deliver very little. So what we try to do is we try to buy the ones that are cheap, sell the ones that are expensive. And that's pretty much it. That sounds like a really concise description, but as I know you know personally, it is a bewildering and broad space to actually get to know deeply. I've been at it for 30. I'm a smarter than average guy. I've been at it for 33 years, and there are a lot of tens of thousands of people who are way better at it than I am. So it's a big animal to try and condense into a soundbite. As far as what a quant hedge fund does, A quant hedge fund tries to separate its decision making. So there's virtually no times where we as hedge fund managers will say, I like this, I don't like that. That opinion is of very little value in a quantitative hedge fund. The odds say this, the odds say that, the numbers say this, the numbers say that, the data says one thing or another. Well, that's a different story. That's a strong argument for us. So our goal is to base all of our decision making on objective and verifiable quantitative phenomena. We want to base it on the math, basically. And even that comes with lumps. I don't know if you know who Cliff Asness is, but he is the CEO. I think he's retired now, but he was, until very recently, the CEO of a quantitative hedge fund called AQR. I've never actually worked for Cliff, but I've met him a couple of times. And his fund is a $30 billion quantitative hedge fund. He put a tweet out the other day that said, a quantitative strategy at best works a little better than half the time. So what you actually need is a bunch of different strategies that'll each work in different circumstances. And this is something that I and the rest of the quantitative industry has been saying for decades, right? If you've got a strategy that looks like it's going to win 90% of the time, that's more problem than solution.
That's something maybe we'll hit that next week as we get into short vol and long vol and breaking that down.
That was actually a big joke in the industry for many, many years. Whenever somebody brought up short vol, everybody looked up for me because I must be complaining about it.
All right. So let's get into, let's see with how much time we have. We'll see if we can get in at both here. But let's go up to the banking industry right now. So obviously, I'm sure most of the listeners are probably fairly well versed in everything that's happened in Silicon Valley. We're talking about institutions at such a high level, and you and I have had plenty of conversations. Not all institutions are created the same. Obviously that, but even not all institutional investors are created the same. And obviously, Silicon Valley is not trying to present the same risk management that all institutions are, but we know that they've certainly failed with how they manage their assets. Can you go after a little bit of let's go after rho risk here? But so we always say that we're trying to be beta neutral, gamma neutral, rho positive. Can you go after rho risk, what that actually is, and where the banking situation probably sits today?
So, in one of the big separating lines are in capital markets trading are those people who were trained at a large investment bank like Goldman Sachs or JP Morgan, which is where I was trained, or Morgan Stanley, and those who were not. For those people who've been through those big bank training programs, it's really the best possible financial education you could get. And I think on the second day of the training program, they said that rule number one in a bank is you do not lend long and borrow short, because when interest rates go against you, when interest rates go up, you're going to be caught out. You're going to be stuck. And that's literally what happened in Silicon Valley Bank. They broke the very, very, very first rule of banking, which absolutely everyone in the industry is taught on day one of their arrival in the space. I can understand that. And that circles around to rho risk. So you said beta neutral, gamma neutral, rho positive. And that is, beta neutral is when the market goes up, that's positive. And beta, when it goes down, that's negative. So we want to be neutral. We don't want to care if it goes up or down. Gamma has to do basically with speed. Is it going up quick or is it going up slow? Is it going down quick or down slow? That speed is gamma. Rho is sensitivity to interest rates. And we want to be rho positive. All banks do, which means you want to make just a little bit more money as interest rates rise. There's lots of reasons for that, because the industry typically is slowing down as interest rates rise. There's less business being conducted, so you need to make a little bit more per unit of business. And you don't want to get held out in what's called duration risk, where you have to pay a lot of people cash today, but you're not going to have cash available for 3 months or 6 months or a year or 5 years or whatever. Right. Silicon Valley Bank was buying treasuries So it's not like the bonds were useless. The problem was a bunch of people showed up at the door at the same time demanding their cash. And the only way they could provide it was by selling the treasuries. When you sell those treasuries, you drive the price of the remaining treasuries down. So they get themselves in a lot of trouble that way. And it's the banking industry is like any other industry. Some, like the auto industry is a good example. Some people make a really great car. Some people make a not so great car. Some people make, varying prices of cars or whatever. The banking industry is the same way. Firms like Goldman Sachs and JP Morgan and Morgan Stanley are viewed as the top 1, 2, or 3 banks in the world in terms of risk management across any spectrum of measurement. Regional banks are typically a little less skilled at quantitative risk management, which all 100% of the banking industry engages in. And Silicon Valley Bank was unique because it had one flavor of customer. The only kind of customer it really did well with was startups. Startups, they have their own issues. One thing that's unusual in the startup industry is they fail at a staggering rate. Some of them, 9 out of 10 startups will fail, right? And the industry knows that, and they manage that risk appropriately. But to be a bank catering to just that industry, it left them a little bit more exposed than others. So not to say anything critical of the specific people that did it or the things they emphasized, but there's an old axiom that if you worry about something other than profitability and careful risk management, you're almost certainly going to get something other than profitability and careful risk management. And that's what happened with Silicon Valley Bank. As far as the interest rate situation, that's the Fed.
Well, I think we'll save that one for next week. I think we're going to be about to time here, so we're going to excuse me. We're going to use that as a hook to bring you guys back for next week. So Tom Costello, longtime industry quant, author of The Front Office. Tom, appreciate you joining here.
Always
appreciate you sharing some insight into institutional finance. Next week, we are going to spend some time diving into not only the Fed's position currently with interest rates and how they're stuck between a rock and a hard place. We will go over the crypto industry as a whole for someone looking at investing, for someone who's already invested, seen the wild fluctuations to their account balance as of last year and then what's happening, and try to help people figure out how to smell out the real players in that industry as well. So thank you for joining, and see you next week.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.